September 14, 2019, 4 a.m. UTC. Drones slam into the world's largest oil facility. Saudi crude output drops 5% in seconds. 2 minutes before Reuters even files an alert, over $50 billion in futures exposure has already changed hands. Someone was ready. War and oil have forged a secret empire worth over $100 billion. The question isn't whether it exists, it's who built it and how. On global futures exchanges, war is priced in milliseconds, long before the first cable news broadcast hits the air. The modern war premium is a digital surcharge created by automated panic, engineered by algorithmic trading desks that treat geopolitical shocks as pure mathematics. When physical infrastructure is struck, high-frequency trading systems do not wait for journalists. Instead, natural language processing models and direct satellite feeds ingest the disruption instantly. Within 0.3 of a second of an initial blast, proprietary code sweeps the order books of the Intercontinental Exchange and the New York Mercantile Exchange. The primary vehicles are front-month contracts. Algorithms immediately execute aggressive buy orders on Brent and West Texas Intermediate, systematically draining available liquidity. As prices breach key resistance levels, they trigger a violent cascade of pre-programmed stop-loss orders from rival funds. This forced buying pressure drives a sudden vertical price spike. For these automated desks, the physical reality of a burning facility is secondary to the immediate structure of the order book. These machines extract profit by capturing the massive price gap between a physical event and the public's realization of it. The system converts fear into cash, leaving retail investors to buy the top. The digital panic on trading floors relies on a physical bottleneck. The Strait of Hormuz is a maritime corridor measuring 21 nautical miles wide. Within this passage, all commercial transit is squeezed into 2 shipping lanes, each only 2 miles wide. Through this corridor flows 20% of the global petroleum supply, roughly 21 million barrels of oil every single day. Approximately 2,500 vessels pass through this narrow channel daily, flanked by hostile coastlines. When a threat materializes in the Gulf, the financial shockwaves bypass physical oil inventories entirely. Instead, they begin with paper and mathematical risk. Marine underwriters at Lloyd's and the International Group of P&I clubs instantly reprice transit coverage. War risk insurance premiums for tankers transiting the strait spike from a baseline of 0.2% to 2% of the vessel's insured value. This 1,000% insurance shock immediately inflates shipping costs. Tanker operators face a calculated choice: pay the premium or reroute around the Cape of Good Hope. Detouring around Africa adds 4,000 nautical miles and up to 14 days to the voyage, costing an extra $1 million in fuel and logistics per transit. This cargo delay warps the global market. Traders adjust the Brent forward curve to embed the ballooning freight rates, widening the spread between near-term and future delivery. Automated desks ingest this distortion, executing aggressive buy orders that push benchmark prices higher. Within weeks, this premium translates into expanded refinery margins and higher retail gasoline prices. Fear of scarcity becomes a physical tax paid by consumers at the pump. During the third quarter of 2019, the financial filings of the global oil majors exposed a stark structural reality. Profits rose as physical output shrank. ExxonMobil reported a 45% increase in quarterly net income, while its daily production dropped by 1%. Chevron posted a 38% profit surge, yet its actual physical barrel output fell by 2%. Shell saw its corporate net income climb 40%, with completely flat production, while BP recorded a 42% earnings spike despite a 3% drop in physical extraction. These enormous financial windfalls were not accidental. They were the mathematical result of widening refining margins and downstream pricing power. As regional tension spiked, downstream crack spreads, the profit margin between the cost of raw crude and the final selling price of refined gasoline widened from $15 to $23 per barrel. This downstream margin expansion alone delivered over $2 billion in clean incremental earnings across these four integrated giants in just 90 days. The system generates cash without extracting a single extra barrel of physical oil, relying entirely on higher realized prices for the barrels already in transit. To secure these massive paper price gains, corporate energy trading desks deployed a precise hedging matrix. By purchasing outright futures contracts and structuring complex collars and options, the majors locked in their price upside while isolating themselves from sudden downside market corrections. The corporate playbook is entirely mechanical. These companies avoid drilling expensive new wells, choosing instead to capitalize on global volatility through realized pricing, downstream capture, and strategic paper market positioning. While some market participants bet on prices going up, institutional players trade pure volatility. An option straddle is a strategy designed to profit from sharp price moves in either direction by buying both call and put options at the exact same strike price. 48 hours before the 2020 Soleimani strike, a reconstructed Brent futures position captured an implied volatility jump from 13% to 48%. This sudden premium expansion inflated the trade's value by approximately 250%, converting geopolitical shock into immediate profit. Defense stocks act as parallel indicators of these flashpoints. On the day of the Soleimani strike, Lockheed Martin shares rose 1.8% and Raytheon Technologies climbed 2.2% in early trading, moving in near lockstep with the sudden surge in Brent crude. This volatility rewards timing, and mandatory disclosure filings map a precise trail of anticipation. Within 48 hours of the September 2019 Gulf attacks, 3 members of the House Energy and Commerce Committee purchased $210,000 worth of oil-linked exchange-traded funds. Similarly, just before the 2020 strike, 2 U.S. senators bought $340,000 in defense sector stocks, including Lockheed Martin. These public filings document flawless execution, not explicit proof of intent. But they show how the financial machinery of conflict consistently extracts extraordinary wealth for those positioned ahead of the trade. Between 2019 and 2022, the financial machinery of conflict generated over $100 billion in cumulative excess earnings. This is the structural reality of the secret empire. It does not operate through isolated trading desks or disconnected events, but through a unified, self-reinforcing machine, where physical destruction is systematically converted into private return. The windfall is distributed across a pre-positioned syndicate: integrated oil majors, commodity hedge funds, defense contractors, shipping insurers, and politically connected portfolios. Each participant operates within a shared incentive structure. When tankers are seized or processing plants burn, these entities do not face actual risk. They simply capture the expanding spread. This entire financial architecture relies on a permanent asymmetry. While the gains are strictly privatized, the immense liabilities are systematically offloaded onto the public. The public burden is direct and severe: inflated energy prices at the pump, heavily disrupted maritime supply lines, and long-term economic damage that drains national capacity. Under this system, war is no longer treated as a breakdown of international order. For powerful energy and financial interests, military escalation has been successfully engineered into a repeatable high-yield asset class. The machine requires volatility to generate yield, and the global consumer pays the ultimate premium. Subscribe to keep following the money. Today, peace is a market liability. As long as crisis drives the futures curve, volatility remains the ultimate financial weapon. Conflict isn't a disruption. For those holding the ledger, it is the business model. Subscribe to expose the machinery of global wealth.